There's the closing bell on Wall Street, and now it's market domination overtime. Jared Blickery going to be along in a moment to get us up to speed on the action from today's session, and there was a lot of it. Let's take a look at where the major averages ended the day. The Dow just up off its lows of the day, but barely, down by nearly 650 points, off by 1.5%. Now, there was selling, sort of deterioration in the morning, and then selling accelerating into the afternoon as President Trump seemed to confirm that indeed the tariffs of 25% on Mexico and Canada are going to affect midnight. There's not going to be a last-minute reprieve. Then also the White House, a White House social media account had tweeted out that he also signed into effect the tariffs on China that now amount to 20% on top of what they had been under his previous administration. So all of that equaling some selling in stocks. The S&P 500 down by 1.75%, and the Nasdaq, the worst performer of the three major averages, down by more than 2.5%. Let's take a look under the hood now. Jared's is here for that. Hey, Jared.
Hey, thank you, Julie. This is the worst day for the S&P 500. We'll dial that up behind me. Since 12/18, that's December 18th, that was a Fed day. That was a hawkish Fed meeting, and we haven't seen anything like that this year. Let's take a look quickly at the 10-year T-note yield. That's down 5 basis points. Also, the U.S. dollar index was down not even 1%, but usually, if you follow my work here, usually this is risk on. This is a risk on thing if the dollar is down, if the yields are down, but that is not the case today. This is tariff uncertainty, and the interplay between bonds and stocks is a little bit nuanced, is pretty nuanced, and somewhat complicated, so that did not translate today. I want to point out XLK and XLE both down more than 3%. There we go. Pretty bad day for energy. Worst day in several months. Also seeing crude oil down to multi-month lows. That has to do with the demand picture. So not even a weaker dollar, which is usually good for commodities, could help that complex today. Crude oil is suffering a bit of a decline, not shown here on the screen. Want to get to the NASDAQ 100. That's where a lot of this carnage is. NVIDIA down over 8%. This is the worst day since DeepSeek. I'll show you a year-to-date chart so you can see how that is deteriorating. Now we're at the lowest point for 2025, down about 15%, and we're seeing all chip stocks under a bit of pressure today. Well, not NXPI. You can see that little rectangle down at the bottom. That's up 44 basis points, but AVGO, that's Broadcom, down 6%, Taiwan Semi down 4%, the list goes on. If you peek inside the ARK Innovation Fund, a lot of these names are down substantially as well. Hood is down about 6%, looks like DraftKings down 5%, Shopify a little bit less than that. And if you take a look at the Dow, which has tended to be a little bit better, do a little bit better on the days when the NASDAQ is down, we're not seeing too much strength there. We got some strength in PG and J&J. Those are typical defensive plays. So pretty risk-off day, and I'll send it back to you, Josh.
Risk-off is right. Thank you, Jared. For more on today's market moves, let's welcome in now Emily Roland, John Hancock, Investment Management Co-Chief Investment Strategist. Emily, it is great to see you as always. Got stocks in retreat. I've got red all over my screen here, Emily. President Trump says, indeed, yes, confirming these tariffs are coming on key trading partners. Investors trying to make sense of this, Emily. What does it mean for the economy? What does it mean for earnings growth? I'm sure you're getting questions from your clients. What are you telling them?
Yeah, sure. So the geopolitical backdrop is certainly driving markets as of late, whether it's from, European defense stocks to crypto and crypto-related assets, and today to the broader market's reaction of the imposition of tariffs. We tend to focus more on the fundamental backdrop. Investors can get really easily whipsawed if they try to trade on geopolitical headlines. So when you look at some of the relative winners and losers today, there's certainly not an earnings story here. Again, this has very much been driven by the headlines. I think the manufacturing ISM data also gave us a bit of a whiff of stagflation with the new orders component coming down meaningfully. You also saw the prices paid index going much higher. I think that the challenge right now is to sort through the noise and try to figure out if there was some sort of pull forward in demand in anticipation of tariffs coming, really providing the impetus for a mini reacceleration and economic cycle that we saw to end last year and to start this year, and now seeing a bit of an air pocket, a bit of a give back of some of that demand that we saw being pulled forward globally.
Well, Emily, I guess that gets to the question of Okay, yes, you can ignore the geopolitical, the trade headlines, but you can't really ignore the economic data, right? So how do we figure out if there is a more profound slowdown going on here? That seems to be what the market is really concerned about here.
Yeah, it's a great question. And what we're seeing right now is the Citi Economic Surprise Index is rolling over. The Atlanta Fed GDP Now forecast for Q1 GDP is now negative 1.5%. And there's really a few things driving that. One is imports, exports. Back to the narrative that we just talked about. We pulled forward a lot of demand, importing a lot, and then exports were limited. We've seen the housing data softening. We've seen consumer confidence and consumer spending slowing. Not terribly, but we're starting to see that make an impact. Now, there is some good news. There are some bright spots in the economy. The labor market is one, and that's a really critical one. We watch weekly initial jobless claims, and while they did pick up to 242,000 last week, there may have been some noise around that, and they're still at very low levels. We've been in the low 200,000s for the last couple of years. So as long as the labor market remains healthy, that's a good thing. We also watch high yield bond spreads, still very, very contained. That tends to be sort of the canary in the coal mine, the sign that there might be something more nefarious happening from an economic growth perspective. And we're at about 280 basis points over treasuries, picked up a little bit, but still very, very low. So those are the two leading indicators that we'd be watching closely for signs that there's something more sinister brewing.
Emily, where's the Fed in this conversation right now? We had another smart strategist recently tell us, in his opinion, the Fed's kind of stuck here.
Yeah, the Fed is not making the headlines right now, which frankly, they're probably pretty happy about kind of staying on the sidelines for now. Again, the employment picture is decent. Inflation is slowly moving back down to the Fed's 2% target. Of course, there's some noise right now around tariffs and the potential for that to be inflationary. But on the other side, the housing component of inflation is seeing some meaningful downside pressure. Demand is very, very challenged right now. Insurance costs are high. Mortgage costs are elevated. Unaffordability is a big issue, and supply is coming back online. So we actually think the shelter component, which drives about 2/3 of CPI, is going to see a meaningful move lower, especially as we head into the back of the half of this year. So the Fed can't really do enough with the dual mandate right now to resume cutting right now. But we think that they're able to do that again as the second half of 2025 plays out.
Emily, when it comes to strategy, we've talked to definitely a number of strategists lately who have said, it's just too noisy. Let's look for where there is more upside. And maybe that's Europe. It has been Europe this year. You saw defense stocks, as an example, go up today on the thinking that they're going to be able to service what's happening now, funding Ukraine and its war against Russia. Are you in agreement? Do you think that Europe's an attractive place right now as well?
Yeah, it's remarkable to see the outperformance of non-U.S. equities and emerging market equities to start this year. I would point out that in the fourth quarter, U.S. equities absolutely trounced non-U.S. equities. A lot of that based on the post-election excitement, animal spirits, America First policies, pro-cyclical policies, tariffs, all, again, contributing to that. So there's a little bit of a give back. You're also seeing, non-U.S. assets were pretty unloved. So there's, I think, some performance chasing here, some momentum going on in the space. You look at really the fundamentals again, and earnings growth just hasn't been that great. In Europe, it was about flat in 2024. We've seen much more exceptional growth here in the United States. Analysts are penciling in about 12% earnings growth for the S&P 500 in 2025. It's less than half of that overseas. So we still firmly believe, Julie, that over time, stock prices follow profits. So we are emphasizing the U.S. But listen, we've had international stocks in the portfolio for a decade now. It's pretty great that they're actually starting to work and provide some diversification here. So we'll take it as long as this momentum trade continues to run.
Emily, one sector in Europe, I'm just curious to get your take about European defense stocks. Why are those making headlines?
Yeah, so you're seeing with the news that came out of Washington on Friday that there is potential for Europe to get more involved in the Russia-Ukraine conflict, and that is something that has created a sentiment shift around some of those names. We looked at the earnings trends; they're okay. When we look at Europe broadly, the industrial sector, which includes those defense names, is a bright spot within international indices, but still seeing more favorable trends here in the United States. We really don't want investors to get whipsawed by trading on political headlines. And we think this may just be another example of that.
Emily, great to see you as always. Thanks
Me
for
too.
joining us.
Thank you.
We got some earnings now that we want to check in on, taking a look at shares of Okta. That company's latest quarterly results hitting the wire, and the shares up a quick 10% here. That's as the numbers beat estimates and the forecast beat estimates. Earnings per share in the fourth quarter on an adjusted basis, 78 cents, 4 cents above estimates, and revenue rising as well, about 10%, and also beating estimates. And for the 13% was the increase in revenue. 10% is what the company is expecting to see in its first quarter in terms of the revenue growth. So it says at least it's expecting revenue of $678 million. That low end of the forecast is above what analysts had been anticipating. And for the first quarter, earnings per share estimated at 76 to 77 cents. Analysts had been looking for 70 cents. So beating on all counts here.
Heading into this print, this one's interesting because the stock was down nearly 20% over the past 12 months, though it was up about 15% so far this year and tacking on another 12% here in the after hours. Remember last month they did announce that restructuring plan, reduced their workforce by about 3%, talked about reallocating resources. I'm interested to hear more about that. Also, they've spoken about their focus on kind of go-to-market improvement. So a couple of big trends and themes I'm interested to hear more from their CEO about that.
Yes, well, guess what? We're going to hear from their CEO.
Just like that.
Yeah, be sure to catch Yahoo Finance Executive Editor Brian Sozzi's exclusive conversation with Okta CEO Todd McKinnon. That's on the Opening Bid podcast. You can find this episode on our website right now. But here's a little teaser from Okta's big numbers and tech takeaways.
Earnings upside, revenue upside. I mean, take us through, what drove some of these numbers.
Well, I think big picture, identity and security are very important for companies in every industry, governments across the world, and it's reflected in our earnings and our performance in Q4. We're very excited about the numbers, about the growth, about the profitability, and more importantly, about what it means for next year and beyond. We're in a big industry, it's growing fast, and we're a key player in that industry that's providing a lot of value to a lot of customers, and we couldn't be more happy.
Customers that come to you wanting to do business, what are they asking you for right now?
Well, I think the main thing is they want to be more secure, and they want to innovate, and they want to do that at the same time that they can move their businesses forward. The whole point of this is what is their strategy? Whether they're trying to expand their customer base, whether they're trying to make their employees more productive, whether they're trying to use systems in the agentic AI revolution. They're all trying to be more productive for their strategies, but to do that, they have to get their infrastructure in order. They have to make sure the right people have access to the right systems, the right machines have access to the right applications, and you have to do that with a foundation of identity, and that's what we bring to them, a whole platform of products that can rationalize their identity across their entire ecosystem and make it secure and make it easy to manage and easy to get onto business.
I've talked to so many people this year, Todd, about AI agents. Everybody's AI agents. Everything's AI agents. Like, what are these going to do to the insides of companies?
I was talking to a big prospect a few weeks ago, and these folks in IT and security, they are in the same conversations and the same conferences that you are. Everyone's talking about AI. Everyone's talking about AI. And he was reflecting a story to me where he said they looked around the room to each other and they said, all this stuff is not going to work unless we can get our identity squared away. And what he meant is that all these AI agents, they want to do work on behalf of users. They want to supplement users. They want to do some of the rote tasks and then maybe have a real person step in for the critical steps in the process. And the only way you're going to bring that together is if you have a good organization of who should access what, and how your systems are accessed, and which machines and which devices can access these things for all these use cases. So identity is an enabling layer for this agentic revolution, and that's what we can bring to this customer, and that's what we're bringing to customers across the board.
Well, investors might view small caps as a safe haven from President Trump's new round of tariffs. Our next guest says the numbers might suggest otherwise. Joining us now, Ryan Grabinski, Strategist Securities Managing Director of Investment Strategy. I guess, Ryan, that maybe the action, the Russell 2000 probably says otherwise as well today, since we saw it tumble on some of the latest tariff headlines. I mean, people are looking for places to, I don't know, hide maybe is a word from what's going on right now. Is anywhere in small caps a way to do that?
So it's great to be here, first off, but I will say, I think that's a pretty consensus idea that the fact that small cap companies have a greater share of their revenue from domestic sources, that they're likely going to outperform. That's not what we saw back in 2018. They were relative to the S&P 500. They were underperformers then. It's hard for me to kind of get on board with them now. When I look at the earnings picture, though, I think this is what's getting everyone's attention, is that when you look at the earnings picture, the second half of the year is actually expected to exceed that of larger companies. So I think there's this relative trade that's getting everyone excited about them. But I'm not sure that they have this, they're not going to have the same boost that they saw in 2017 to 2021, where we got this corporate tax cut. So it's not exactly, a great place to hide. I think another, what's probably more interesting is if you think about potential industries that could actually benefit from the tariffs, right? So one of the things that I'm thinking about here is the fact that if you think about, okay, there's going to be 25% tariffs on autos potentially. That ultimately, what does that ultimately mean? How does that resonate into an industry like insurance, for example? If auto prices are going up, insurance premiums are going to go up. Perhaps that's one industry that has pricing power. The other industries, maybe that is kind of getting away from small caps, but a similar idea on the domestic revenue focus is actually the utility sector, right? The utility sector in the fourth quarter was really driven by the AI, the additional need for power generation and AI. But perhaps now it's simply the fact that consumers are going to pay their utility bills. Everybody has to pay it, and they're getting rate increases, right? I know in my home state of Connecticut, we're seeing 7.8 to 10% rate increases. When I travel throughout the country, that's pretty common from what I hear from our clients as well. New York's going to see a 10% increase. I was just in Boston last week. They're talking 10, 11% as well. So it's certainly, utilities might be a place to hide. And when you go back to inflation, that's a really small component of CPI overall. So, thinking about areas that could potentially benefit from the tariffs is a different approach. Everyone wants to talk about all the negatives that we're hearing about in the news every day, including, not too long ago today.
Ryan, kind of a bigger question for you, a broader question. I know you say when the market is moving against you, and there's a lot of red on the screen today, you say, Ryan, it can be kind of tough for investors to keep their perspective. So help us with that perspective, Ryan. Just big picture, where do you think we're headed?
Yeah, I mean, we have to keep things in context, right? So it was February 19th where the S&P was at an all-time high. So if we were having this conversation 2 weeks ago, nobody would be concerned about tariffs. They'd say, oh, there's nothing going on. I mean, the market's down. On an average year, the market declines by about 14 or 15%. The average drawdown. We haven't seen one of those in the past several years. So it's really a lot of investors are really quick to jump to this idea that we're going to a recession. But we're seeing a momentum unwind. We're seeing a growth slowdown. That's certainly showing up in the Atlanta GDP now numbers. But the question is that already priced in? And are we going forward? Is that going to change? Keep in mind, there's a lot of focus on Trump and tariffs. He also has the power to reverse all of this, right? We know that he's a market watcher, and any day he could ultimately say, okay, we've achieved what we wanted to achieve by announcing tariffs on Mexico. We're gonna hold back for now, and I think that would really reverse the sentiment that we're seeing in the negative sentiment that we're seeing in the markets. That would probably get investors on the sideline, off the sidelines, and say, okay, we can kind of rotate back into those more cyclical sectors and remove that defensive tilt that we have.
Sure, he could. But man, who needs the stress, Ryan? Like day in and day out. Oh, it's a negotiating tactic. No, they're going into effect. Oh, maybe they won't go into effect. Maybe they'll be, as an investor, you got to make decisions. You got to push the button one way or the other. And it's hard to push the button when you don't know the answer to that question, right?
Certainly. I mean, you could say the same thing about, from a corporate financial planning perspective. They come up with their budgets well out, and if you don't know what the rules of the game are, what the rules are going to be, it's hard to make that capital investment or make that decision. So I certainly understand that, from an investor standpoint. But at the end of the day, we have to kind of play the cards that we're dealt. And if this is the market that we're in, to me it makes sense to kind of have, okay, you have a defensive tilt in a portion of your portfolio, and then you have you add opportunistically to the more cyclical areas that may have been driving themes that are likely to be secular themes over the next 3 or 5 years, and you invest opportunistically. Now that might be easier said than done if you're fully invested, and so it's difficult to navigate. But it's certainly the market that we're in, and until something changes, that's kind of the approach that I see you having to take.
Ryan, great to see you today. Thanks for joining us. Appreciate it.
Absolutely, great to be here.
Markets brace for new tariffs, with President Trump's decision-making on the economy appearing to be weighing down on both the investing and consumer outlook in the U.S. But what does this mean for small businesses? Joining us now to discuss is Elizabeth Gore, co-founder of Hello Alice and host of Yahoo Finance's upcoming new podcast, The Big Idea. Elizabeth, it is good to see you. So listen, rough day to be long the markets today. President Trump confirming that, yes, those tariffs on our key trading partners are coming. I'm curious, Elizabeth, on that issue, what you're hearing from small businesses about these potential tariffs. How are they thinking through these potential tariffs? How are they preparing for them?
Yeah, there's a sense of nervousness, particularly when you think about your coffee shop, your dry cleaners, folks who have to buy supplies day in and a day out. The costs of goods sold are going to go up, whether we like it or not, and they're either going to have to absorb that cost or they're going to have to pass it on to the consumer. And when you go to that same coffee shop every single day and it goes up 10 cents, 15 cents, 50 cents, that is going to matter. Now you go over to larger areas where folks need actually electronics, things like that, that is also going to impact unit economics for long-term sales.
So are you saying, we're seeing in the sort of big picture economic data some evidence that people are ordering as much as they can now before tariffs go into effect. Are you seeing that among clients and among folks in small business, that the things that don't go bad, are they ordering it now?
A little bit, but I will tell you that's more the medium-sized businesses. Most small businesses have less than 3 months cash in the bank. So, and they have to do payroll, they have to pay taxes, they have to pay intermediate costs on different things. And so it's very hard to stock up. And frankly, I think it's bad business planning. You really want to be careful with supply and demand and want to do those orders once you know what the demand is going to be with your customer sets. Additionally, most small business owners have perishable items. So to be honest, it's just a tough situation, and stocking up is not really likely.
And Elizabeth, with small businesses, the NFIB showing optimism kind of rising among industry-specific small businesses. I'm just curious how that matches up to what you're hearing.
The reason I love small businesses is they're resilient, and there is an overall sense of optimism, particularly in areas like you look at construction, in real estate, and others. And that is, to your point, where we can buy a little bit ahead of time. But the NFIB came out with a great survey that shows there is a sense of optimism. A lot of that is from receipts coming out of December and January. Receipts are up, so that's a good thing for small businesses. And we're actually on almost a 51-year high on optimism. So we need to make sure we match that with cost of goods sold, and also let's keep trying to get capital to be less expensive to match that optimism.
Elizabeth, thanks so much for joining us today. Appreciate it.
Pleasure to be with you.
For more on navigating the world of small business, be sure to catch Yahoo Finance's upcoming podcast, The Big Idea, hosted by Elizabeth Gore. That's premiering April 24th at 12 p.m. Eastern.
That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's asking for a trend. I've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned.